Hello everybody. So in today's video, I want to talk about why I own hypergrowth stocks and hypergrowth stocks only, right? I don't touch the S&P 500. I don't touch any stock that grows at the rate of the economy. I want hypergrowth. My threshold is 30% revenue growth minimum. And why do I own Bitcoin? And the reason for that is because I think part of the art of investing is trying to earn a real return, not a nominal return, a real return. A real return is very different from a return that you see in the dollar amount in your account. It's beyond the dollar amount. And to earn a real return, you must beat monetary inflation. That's why the channel is named Beat the Denominator. You must beat monetary inflation, the denominator. And what do I mean by the denominator? The denominator is that of our entire economic life, that which we divide everything by. We divide everything by the US dollar. Everything we value is divided by the US dollar as a denominator. For example, our jobs, whether we work somewhere or not, that's divided by the amount of dollars, right? Our time, we exchange it for dollars. That's the denominator. Stuff that we buy, services that we buy are based on the dollar, right? They're quoted in dollars and you decide I'm going to buy it or not based on the amount of dollars that it is divided by. Everything that we value in life is quoted or divided by US dollars. And so let me ask the question this. Do we want new dollars, right? Like what happened last week with the not a bailout of SVB, right? Do we want new dollars? Well, let me show you this little analogy here. So imagine having an excellent wine. I like wine, but I could say, imagine having an excellent beer or coffee or tea. Like you have the best of it, very high-end, fine wine. It's desirable, right? It's very, very valuable, that wine that you have. It's really, really high-end. And then imagine this. Imagine that someone starts pouring water into your wine, into your very valuable, enjoyable wine that people want to buy and that you want to consume. Someone starts pouring water in it. And then what was a little bit of wine, right, delicious, is now diluted wine because someone added water to it. Not you, but because you still own the wine in your hand, but someone added water to it for you. And so the question I ask you is, when you have someone add water to your wine, is it the same wine? Are these two wines the same wine? And if you think so, then you may really like things like modern monetary theory. And you may really like anything that has to do with fiat thinking and the idea that we need to finance projects to launch the economy, the idea that we need to engage in monetary stimulus and stimulus of your kinds. And you're likely familiar with Keynes, and you're likely a Keynesian economic thinker, which is more like classic economics. You're probably more into a Keynesian type of thinking and believe that MMT is okay if you think that is the same. But you know, that is not exactly how I think, because the way I view the dollar, hence why the channel is named Beat the Denominator, is I view the dollar as something that should not be altered with. But let's say you save US dollars. Say you have a savings account at the bank, or you save in US dollars in the form of treasuries, like you buy T-bills or you buy bonds. Say you save the US dollar. Well, saving the US dollar is like having someone pour water into your delicious wine. When you earn that dollar, that sweet dollar that you're earning from your labor, you know, you're happy, right? It's valuable when you receive it. It is valuable when you receive it, but when you set it aside and hoping to get it back, say, in 30 years, in the case of 30-year bond, you are getting interest, and you're like, it's good. You're getting nominal interest. But in reality, it's an illusion, because even though you're getting a nominal interest and the number is going up, just like the quantity that you see in the wine glass would be going up, actually, it's getting diluted. Both your principal, right, the money that you've set aside, and the interest that is paid to you, both of those are getting diluted over time. And that dilution is the story of the US dollar. That is what that dilution is all about. What you can see is that when you, let's say you earn the money in 2012, that money is the same as fine wine. When you just earn it, that money has the value that you expect. And let's say you fast forward 10 years from now, from 2012 to 2022. Well, we've had realized growth in the money stock. This is the real number, what I've calculated. We've had realized growth in the money stock at 11.79%. So it's like they've poured 11.79 more worthless liquid into your wine. So you're getting diluted at 11.79% each year. So your wine every year starts tasting less good because every year they add ever more water. And to the point that if you go to this level, right, if you wait to this level, you have more than a half diluted wine, right? Even less, actually, probably less than half. And if you go for the full 10 years and you include both eurodollars and M2 money stock, you actually get to up to a 3x. You get to about a 3x of dilution because, as you can see, is you have $55 trillion right here, so it's like a 2.5x, $55 trillion right here, and you only had like 18. So 18 to 55, almost a 3x in dilution in 10 years of the money. That's what the money is being diluted by. And so your money is less valuable, but you can't see this. You can't see this because I already know what people are going to tell me is, prices have not tripled since 2012. You're so wrong, right? My prices, I tell you, this is about a 3x dilution from 2022 to 2012, and you may say, my prices have not tripled. I'm wrong, right? I'm wrong. Well, I would say I'm right. If you're right, right? If you think that I'm wrong, you're right. If you look at stuff in the CPI, right? Stuff in the CPI actually over the past 10 years is only up, official data, only up 28%. So your money has only been diluted by 28% over the past 10 years. But here's one of the problems with the CPI. The CPI does not include many very desirable assets. Assets like, say, fine wine or art or what asset I'll show you in a little bit. It includes stuff that can be easily ramped up and manufactured through bigger factories, lower quality products, smaller dimensions on your product, less, like the classic example is you have a TV dinner and you post less meat year after year on a smaller quantity. This is all stuff that can be easily ramped and manufactured. So that's why the inflation, the CPI number does not capture the full extent of the money dilution. Actually, the CPI assumes that you're going to rent your whole life and that you don't want to aspire to ever own a home. That's one of the things that the CPI assumes. So we can see that because of that basket of a CPI, a lot of the items in the CPI are not going to dilute as fast as the US dollar because those items are getting ramped up. Those items are getting printed in factories really, really, really fast, albeit not as fast as they print the US dollar, but it's still being printed really fast. So you don't feel it as much in things like the CPI. But let me show you one thing where you feel it. A single family home. Single family homes track monetary printing almost to a T. Why? Because let's take the case of the USA. In the USA, there's about 83 million single-family homes in the USA, and I think we can all agree more or less then for the average American, having a single-family home, detached in a safe neighborhood with decent schools is like the American dream. That's like the ultimate good that every single family aspires to. That's the number one good. And that number one good, we can't print it. We can't print it like we print US dollars. In fact, during the good years, the maximum that we can print homes, i.e. build homes, is 1.3 million homes. We can only build, and that was 2021, remember, the biggest year of real estate in history. We built 1.3 million homes extra each year, which is what? A 2%, 1.5 to 2% max. I ask you a question. How many homes do you think are going to get built from mid-2022 to mid-2023? Way less than a million. Way, way less. Construction is way down. People are not building homes right now. And so what's happening is we can't build homes nearly as fast as we can crank up a factory and make TV dinners, or nearly as fast as we can, make cheap stuff, right? Build homes is tough. It's very, very tough to build a house. So the supply of single-family homes in good neighborhoods and safe areas, that supply stays roughly the same. Maybe you add on average 1 million a year, but it stays roughly the same. It grows about 1%, 1.5% a year. But the US dollar grows at my estimate now 15% a year. That is my numbers. I follow this stuff so closely. My estimate of the US dollar grows at about 15% per year if you count eurodollars and M2 money stock. And we can only grow houses by 1%. We can only make 1% more homes every year. And so what that means is that, surprisingly, or not, actually, not surprisingly, the single-family homes, the price of these homes clearly tracks monetary printing, in my view. And you can also take the same chart and map it over the S&P 500, right? Kind of a lot of low-growth stocks. If you look at a lot of low-growth stocks, they will match closely the money supply, right? And so that's why if you look at the average returns of the S&P 500, right, that does not even keep up with that money dilution, with that money supply. And so it may look like if you're going to be in the market for cheap stuff your whole life, you're going to be ahead. But if you're going to be in the market for fine things, and by the way, I don't think we should put a single family home as a fine thing in there, but we do. If you are in the market for these things, well, it's gonna be awful. It's gonna be awful to save in US dollars, and it's gonna be awful, in my view, to save in the S&P 500. You have to save in things that are going to beat the denominator, that are going to beat the dilution. And so, what do we know today, right? What has changed this week? Like since last Monday, what has changed? Well, we know that water is coming back into the wine. Dilution is starting again. This is a very serious article from JP Morgan talking about JP Morgan strategists saying that the step could need to backstop as much as $2 trillion for the banks. And keep in mind, when the Fed backstops, right, when the Fed is going to redeem those losses at par, that's base money. That's new monetary printing, and that's adding more water to the wine, right? And if you look at this, clearly in 2020 we had a tremendous add of water to the wine because the government spent a lot of money, and so we had 3 more trillion added to that chart, right? That's the water in the wine. We had 3 more trillion added to the stock, to the money stock, which is past 55 trillion. We added 3 more trillion. And you can see the Fed started raising interest rate and slowly started reducing that balance sheet, right? That's just base money, by the way. That's not M2. That's just base money. Started doing a little bit of reduction of the balance sheet of the base money that it created, right? It destroys the money as it gets it back, and barely made a dent. And what did we see with not a bailout of SVB? What did we see? Boom. The last publication, plus $297 billion. And my guess is that over the next few weeks, as they update this data, their balance sheet, you're going to be able to go on the website and see a spike. Now, I don't know if that spike is going to be 2 trillion like JP Morgan says. Actually, JP Morgan in the article says it's it's going to be closer probably to 500 billion, and we don't know what's going to happen. But I can tell you one thing is that in my view, in my definition of QE is back. In my view, they're adding to the balance sheet. This is what's happening because it is never the right time. Reducing the money supply, reducing the money stock, and i.e. that means the Fed reducing the size of its balance sheet, and then us also paying off our debts and not taking on new debts and adding new stocks of debt. Remember, commercial banks create the bulk of the money, right? Then it's the Fed that creates base money, but that's a more recent phenomenon. So we are not having that. We're not having that, even though the market asked us. right? I made this video about 2 weeks ago talking about how we are at the end of a debt cycle and we should be going through a deleveraging stage where we start paying off our debt and reducing the money supply. But right now the Fed decided against it. Like nobody, because they didn't let the banks fail this time in 2023. They saved the regional bank. So our society in general does not want to deleverage. Right? Nobody wants to go through a lost generation and a depression, which is what you would need to pay off the debts, to deleverage. We need 25 years of paying off debt. Our company is paying off debt. Our company is running out of business. Household running out of business. We need 25 years of that to get back into another 8-year cycle, and nobody is willing to do that. SVB actually could have started that. Silicon Valley Bank was well started. It started to do that for us. The markets are saying, okay, let's go, and there could have been trillions wiped out in the money stock at SVB collapsed, right? We could have seen a major drop here. You can have seen a major drop here, like removing water of the wine. We could have seen that, which means that the dollar would have become more valuable. We could have seen that, but we didn't see it. Well, why do we not see it? Because it's never the right time to go through the pain. It's never the right time for the economy to go through the pain. Go back to the history of a market trying to deleverage. 2008. It was not the right time. No, don't do this to our banks. They're too big to fail. Don't do this to the auto sector. Don't do this to AIG. Then 2020. That was another sign of the market telling us, okay, we can go for deleveraging now. Let's go on into a period where we pay our debts and actually go through these painful moments of reducing the money supply. And in 2020, what did we say as a society? Not our small businesses. Small businesses are going to hurt. Not our restaurants, not our airlines. No, we can't in 2020. And today in 2023, the market yet again tried to launch us into a money reduction phase, into a debt payoff phase. And what did we do? We said, no way, not Silicon Valley, not the regional banks. We can't let them go. We can't destroy that capital. It hurts too much. So whenever we have an opportunity to destroy capital, to destroy money stock, is what I mean here, really. Whenever we have an opportunity to destroy the money stock, to actually reduce the size of that M2 for the US and the size of eurodollars for dollars outside of the US, and we see Europe as its own set of issues with eurodollars. Before and eurodollars, by the way, are not just Europe. It's any foreign dollars. But when I think about Credit Suisse, when I think about the UBS mergers, there's dollars outside of the US, which is like also one of the things. Is most people when they talk about that, they only talk about M2 and they forget about eurodollars and this whole shadow financial system of US dollars that exists outside of the USA, but the money gets back into the US, through less direct ways, but that money flows back into the US as well. So we have to count it into inflation. Anyways, we're never ready. We're never ready for it. So because we're never ready, because we never want to go through, say, oh, well, we could have gone through an auto sector bankruptcy and a wave of bankruptcy in 2008. We said no. We could have gone through a wave of small business, a wave of restaurant, a wave of airline bankruptcies in 2020. We said no. We could have gone in 2023 through a wave of tech startups, a wave of regional banks of bankruptcies. We said no. And because we always say no, our solution is always more money creation, always more dilution. And that's the path that we always choose to solve our problems, as evidenced by that stark change in the balance sheet. The faucet is back on, as evidenced by that. And so we never choose right now. Our society does not choose to stop printing. We don't choose that. That's not a choice. We tried. I've always known that Powell was bluffing, right? We never choose to stop printing money for base money for the Fed. They don't want to stop printing money, and then we never choose to lose a generation to start paying things off, to start paying the debts contracted over the last 30 years. That choice is always too hard, to lose a generation. But you can't reduce the money stock without pain. It's not possible. It's not possible to reduce that money stock. All of that money stock is in the hands of everybody. Like, it's in the hands of all of us. Like, if there is a drop in money stock, there's going to be less dollars flowing around, so we're all going to have less. But we never choose to do that anymore. And frankly, when I think about the 1929 depression and the farmers, if that had been an option back then, I am sure the farmers would have also chosen not to go through a Great Depression. I am sure that was not what they wanted either. But today, that's just the path society has taken. We've decided QE to infinity. We've decided dilution forever of the US dollar. And that's the reason why I mostly focus on this channel on hyper growth stocks. Because if you want to have a shot at keeping up with the monetary dilution, at keeping up with that rise in the money supply, right? Keeping up with that. If you want to have a shot for that, you need to grow revenue faster, right? If they add more water, right? If you add 15% more water in the wine each year, your business needs to grow at least by 15% to get the same amount of diluted wine, to get the same share of the pie. If the pie is getting diluted at 15%, you need to get to 15% revenue growth just to keep up, right? Just not to drown, just to stay afloat. Because if the money supply, if the money stock grows more than your revenue, then you're falling behind in real terms. You're falling behind in real terms. So that's why all of the stocks that I follow on the channel, I'm very, very strict on that 30% revenue growth to make money in real terms. You have to have 30%, and that's my threshold, because I want to earn 15% of returns in real terms. So 15% in real terms, that is 30% in nominal terms. That would be 30% in nominal terms. And you just have to do that. So I don't think there's a way out of hypergrowth stocks in my view. Like, if you buy the S&P 500, the S&P 500 grows on average roughly at the rate of the economy. And the rate of the economy does not grow at the rate of monetary inflation, does not grow at the rate of money printing. It's kind of like you're printing, 12 to 15% more money in exchange of 3 to 4% economic growth. So that's kind of a drowning. So that's the reason why I own hypergrowth stocks. I want my stocks, my companies, not to drown in the increase in money stock. And the other reason why I don't want to save in dollars, and the other thing that I do is Bitcoin. And I know Bitcoin is not very popular today, although I'm seeing a few thumbnails like the price is like 27,000 right now. I don't even follow the price of Bitcoin. But you may know that my bond alternative is Bitcoin, is like more than 90% Bitcoin for my bond alternative. I do not own bonds. Like typically they would tell you like, oh, if you're 35, say you gotta have 65% in stocks and 35% in bonds. Well, that allocation to bonds for me is Bitcoin. I actually believe in Bitcoin, and Bitcoin was created specifically for this situation. This is the Genesis block, right? So the first block of the Bitcoin software, and they copied the Times, and the Times is a newspaper in the UK, of course, and they copied here Chancellor on brink of second bailout for banks. And so Bitcoin was created to deal with the issue of bailouts. It's like, no, we don't want to go through the pain. We don't want to lose our banks. We don't want to lose deposits. So we are just going to print more money and dilute the money supply, dilute the money stock. And that's what Bitcoin was created for. Like, Bitcoin was created to deal with that. There's many cryptos, as they call them, but the one crypto that was created to be the hardest form of money is Bitcoin. And I'm very happy owning Bitcoin. Actually, I fell down the Bitcoin rabbit hole in 2015, actually. And I remember selling my Bitcoin for like $250, and I thought I was real smart. Because at 250 a coin, I thought I was real smart of getting out. And this is a similar story that you'll find in a lot of anybody who's like been into Bitcoin. doesn't want to believe in Bitcoin. And it took me multiple years to get back in after 2015 to realize that actually I was right, and that everything that I hear about people telling me Bitcoin's a scam is wrong. It takes thinking for yourself, right? And I guess 7 years ago it was harder to do, 8 years ago now for me, than it is today. Today I don't have a single issue owning Bitcoin. It doesn't faze me. The price can go up or down. I've spent literally more than 10,000 hours over, especially when I fell down that rabbit hole back in the day. When you study something and when you just know it, you know it. And so that's how I feel about Bitcoin. And actually, let me just say just a few quick things, because I know Bitcoin is not popular right now. But I believe it is my duty. This is my channel. I named it Beat The Denominator. I have to cover things that I know some people may not view as popular, but that's the whole reason why this channel is named Beat The Denominator. So why Bitcoin, right? Why do I own Bitcoin instead of bonds, right? Because I love business, and I do believe in growth stocks and taking on business risk. And all of that, and it's great. But when you think about asset planning and you think about your future and retirement and your children, all of that stuff, when you think about that, you have to have a safer part of a portfolio, because you're still taking on business risk, right? When you own stocks, you're taking on business risk. You have competition risk, security. You have a risk from an agency standpoint, right? CEO may steal money, may cheat. You have a bunch of risks that you're taking on when you buy securities, which I'm okay taking on. But also the appeal of bonds, of taking fewer risk, at least in the traditional definition of bond, that appeal is still here. But to me, bonds today are too risky after what I know about the money supply, right? I could not save in US dollars after what I know about the US supply. And I believe Bitcoin is a wonderful alternative for bonds. And by the way, if you study millennials and if you study Gen Z and see what they do, I believe a lot of Gen Z agree with me that actually Bitcoin is a great saving alternative, especially if you see the interest of these neobanks, the interest that they get for cryptocurrency and Bitcoin. I think it's easy to see. But let me just tell you a few things about Bitcoin. But before I do, I want to tell you the assumption. So unless you can build a mining facility with $20 billion worth of Bitcoin miner, and you can build that facility in just a few weeks, and you can power that facility with about 22 nuclear plants with a 4-core nuclear reactor. And by the way, they would need to be very, very close to you because, of course, energy dissipates. And so you need the full power, theoretical power of these nuclear plants to be able to power an enormous data center with $20 billion of equipment. So unless you can do that, you can't break Bitcoin. Per my calculation, setting up this operation, about $20 billion of equipment, and about 22 nuclear plants, the equivalent of power of 22 nuclear plants. So really 88 nuclear cores. Per my calculation, setting up this would take 7 years. And the catch here is that yes, it's theoretically possible to do that in 7 years. I mean, if you used the might of, say, Taiwan Semiconductor to manufacture these miners, and you use that might for, say, 2 or 3 years, you'd probably get the miners, and then you need to build the power and concentrate that power. So if you can do that, and if you can do this in just a few weeks, then you could technically hack Bitcoin. You could technically hack it if you can do that. But you have to do it in a few weeks. And the reason why you have to do it in a few weeks is because of Moore's law. Because computers get so much better quicker on an exponential curve. And so what you could theoretically do in 7 years, you can't do in a few weeks. Or at least I'm like 99.9% sure you can't do it in a few weeks. And so that's kind of how you address the argument of, what if it gets hacked? What if it's a scam, right? And actually, if you did that and you actually succeeded at doing a 50% attack, which is what it's called, 51% attack, which is what it's called, even with that hack, you would likely just create a fork and nobody would recognize the old Bitcoin. There would be a new Bitcoin created, which would be right before the hack, and all of the Bitcoin would be restored before the hack. And going through this calculation right here, and if you go down the Bitcoin rabbit hole, I suggest you go through this calculation on your own and come up with your own numbers. But going through that calculation makes you understand why energy consumption is absolutely essential to Bitcoin. It is what makes it hard property and what makes it anti-fragile. Actually, if you look at, can't remember the numbers, but I think to mine a Bitcoin, you still need something like $15,000 of electricity. So you can't cheat, right? There's no cheating to Bitcoin. You need like $15,000 of electricity. And by the way, it's a competition. So as soon as you successfully mine a Bitcoin, the cost of mining of Bitcoin is going to go up and going to go up. It's not like you can do arbitrage because there's a fixed supply of Bitcoin. The key point here is that Bitcoin gives you the highest level of cybersecurity ever achievable, because the only way to break it is to spend energy. You can't break Bitcoin if you don't spend the energy, if you don't do the work. That is why it's called proof of work. And because it is the largest computer network, it's nearly impossible to break. And so once you accept this as a premise, which you have to go down that rabbit hole, but once you accept it as a premise, you understand that Bitcoin gives you the protection of the strongest nation of the world that has never existed. Protects your money. And this also goes into the fundamental of what is property. Well, property is only valid to the extent that you can defend it. And Bitcoin is the most defensible property. No property is more defensible than Bitcoin. Anyways, so why Bitcoin, right? Why Bitcoin against the US dollar? Well, first of all, Bitcoin cannot ever be inflated past the $21 million cap. The code is the law. Bitcoin is deflationary money. People sometimes lose their coins, and there's a whole trend in the Bitcoin field about people deciding not to pass them on when they die, to just die with the Bitcoin in your head and never use it and not pass it on and make it like a charitable donation to the next generation. Bitcoin has network effects, which make it money at least to between 150 million and 200 million people, which you're getting into the size of a decent nation. So you have kind of a small cyber nation that has begun to accept it, and we are nearing that 5% of threshold, of acceptance threshold, and that's the biggest, right? That's the cryptocurrency that has the biggest network effects, and that's essential for money, of course. But what else, right? Bitcoin is code. Code is law. Nothing can be undone, stolen, inflated, restricted, nothing. You can't do anything, and you can't print it for any reason, even the most valid reason. You can't print it. Like 2020 saving the restaurants, 2023 saving Silicon Valley, all of these reasons that may seem very valid to anybody making an argument. All of these reasons don't count for Bitcoin because you don't have human thought going into it. It's the code. You can't change the code. It can't be undone. It can't be inflated because it's set in stone. It is entirely set in stone. You can't have anybody change the code, no matter what the reason is, which is why it's kind of like Bitcoin was invented to save us from ourselves. It saves us from ourselves. You can't change the code. Bitcoin is stored as speech, which is so essential, right? It's 12 words that you typically want to memorize, but sometimes you want to do it in a 24 word, and there's many different ways to store it, of course. You can do a digital wallet, you can do a Bitcoin bank, which then it's a little risky because you're introducing new counterparty risk. Store it on a flash drive, but the purest way, of course, is to solve it in your head, and you just remember 12 words, and so it's stored as speech, which is of course very, very hard to seize, right? Nobody can seize that. At least as of now, nobody can seize that. Like I don't doubt that maybe 20 years from now somebody will be able to read your brain, but for now you can't do it. And even if 20 years from now we get to that stage where someone can see into your thoughts, then you can have that code spread out and distributed between third parties, trusted parties, etc. And lastly, it's fixed, right? Bitcoin has a fixed declining money supply. It becomes more valuable over time, like good Austrian money should. Right? If you read some of the works of Austrian economics, Schumpeter is the most famous. You'll see that Austrians loved gold, even though gold had some shortcomings. They loved gold, and so this is to me, near perfect money, or at least a near perfect store of value. Because even though the idea of bonds, like if the money stock did not inflate, bonds would make some sense. Like if the money stock did not inflate, bonds would make such sense. And I don't doubt that maybe 20 years from now, when Bitcoin is more accepted, you're going to have Bitcoin bonds. And then it makes all of the sense of the world. The problem is that bonds make no sense right now because the money supply keeps growing. If you imagine a world where the money supply is fixed, then bonds actually provide you a real return, right? The problem is that the return of bonds has never outpaced money stock inflation. It's outpaced CPI, but it's never outpaced money stock inflation, which is what matters. And lastly, I'll say, and this is the most theoretical thing I'll say in this video is we've gotten used for the past 100 years to the idea that prices should go up. But when you really think about it and about how the world works under a real money standard, actually, everything that we do should go down in cost over time because our companies get better, we get more efficient at doing everything. We have productivity gains. And if money supply is fixed, those productivity gains flow onto the production of goods and services. So actually, because we are a species who evolves and who gets better and better and better, over long periods of times, the cost of the stuff we make should go down, not up. And I'll leave you with that to think about. To think about. I think it's an important thing to think about here. So, anyways, I'll conclude with my wine analogy. Bitcoin is wine that does not get diluted with water. It does not decay, right? It's a key innovation. The key innovation is it's able to transfer wealth across long periods of time, right? You can also decide to destroy it if you want it. Forget your keys for the benefit of the world. You can decide to do that. You can't do that with a US dollar. That's why you can't do that with fiat. Is why we have quotes like you say, oh, you can't take your money to the grave. Well, that shifts under a Bitcoin standard. And lastly, and this is what you'll see a lot out there, one Bitcoin equals one Bitcoin. It stays the same. Just like good wine stays good wine. Well, actually it does not because it's not as strong as Bitcoin. Bitcoin is property that you can transfer across time and that cannot be diluted. Nobody can add Bitcoins to your Bitcoin. Nobody can add water to your wine in Bitcoin. But the US dollar, as we saw, they've started adding back they've started adding back. When you look at the balance sheet, it's very, very clear that the faucet is back on, and we'll see that backstop. We'll see how quickly they raise it beyond 25 billion, and my guess is that they'll raise it very, very, very quickly beyond that. So anyways, this was not investment advice, of course. This is just entertainment. I hope you were entertained. Thank you for watching. Please like and subscribe and have a wonderful day. Thank you.